right, welcome everyone. Welcome to our town hall with Infinite Giving's Investment Committee. Today we're talking about navigating financial uncertainty as a nonprofit leader. I believe we have about 150 folks registered today. So first I want to say welcome. I know many of our clients are joining us as well as some of our nonprofit friends, and we're glad you are all here. If you don't know, Infinite Giving is a registered investment advisor that works exclusively with nonprofits. So we are a fiduciary partner to more than 250 tax-exempt entities all over the US. And we work really closely with finance teams and their boards to provide thoughtful financial stewardship to growing nonprofit organizations just like you. Today, you're joining a hopefully fairly informal conversation with our investment committee. My name is Karen Houghton, and I'm joined by Buster Wright. He's the guy in the bow tie on our website. A lot of people always comment on that. And then Rusty Holcomb and Justin Pitcock. And collectively, we have over 80 years of investment experience and management of over $2 billion in nonprofit funds. And there's been a lot of changing times in 2025, and we're going to get through that. And so today, we are here to talk about practical, thoughtful advice for nonprofits. And we want you to leave feeling empowered and encouraged from the webinar today. So it's why we've structured it as a more informal town hall. We found ourselves having so many of the same conversations around the current financial uncertainty that we're all facing. So we decided to invite you guys into a collective conversation. And this is the idea is that we are going to kind of talk through some of the most popular questions that we get. It'll be roughly 4 or 5 questions, so for about the first 35 minutes. And then we are going to open it up 30 to 35 minutes, and then we're going to open up essentially the second half to Q&A. So if you have any questions on the bottom of your screen, you should see a Q&A box there, and you can type that in, and then Lauren is going to be collecting those, and we'll dive into those at the end of our time together. So if you have burning questions you want answered, you can enter those into the Q&A box at any time, and we're ready to get started. So with a quick overview, as you guys may know, 2025 has already been a really tough year for so many of us. Cuts in government funding, executive orders coming from the White House that may or may not come to fruition based on our court system, a down stock market, threats of a recession, and of course, the impact that all these things have on our donors in addition to us. It's been tough for a lot of you. So today we want to acknowledge the difficulties and challenges we face, but we don't want to stay there, right? We want to move into hope. So the first most obvious question we're going to talk about is the fear index. So as a little kind of just setting the foundation, the fear and greed index is a real-time index of the stock market. Go ahead and go back, Lauren, sorry, to the very first one. And the higher the reading is, the greedier investors are, which means a positive market. And then 0 signifies maximum fear. And the reason this is important because it often represents what we're feeling and or what we're seeing in the news. So while there are multiple factors, we went ahead and pulled like 3 slides, and we'll turn it off and we're just going to talk about it. But I wanted you guys to see, because this is part of the market momentum. And yes, you know, it's a little up, but it's been down. And you can see in the big red, it says extreme fear. That's why when we're talking about the markets, you hear that a lot. So this is what a lot of us are seeing and feeling. And then if you go to the next slide, we're looking at the safe haven demand. And this builds into what is showing extreme greed. And that's because bonds can often outperform stocks over short periods of time. And this is where extreme greed is looking into the bond returns. And that's why for a lot of you guys, we talk about fixed income and treasuries and things like that when you have a more uncertain market. So these are just a couple of those metrics. And you're like, all right, extreme greed, it's green, but that's kind of a negative for the market. So the last slide is the overall fear and greed index is still only at a 67. So even though we feel like the sky's falling, we kind of still are landing in the green here as a 67 overall. So setting that foundation, that wants to lead us to question number 1 is, what does all of this mean? And how does it impact nonprofit leaders And the question I get a lot is how worried should we actually be? So Lauren, if you want to not share the screen anymore, and Buster and Rusty and Justin, let's talk about this. Should we be scared? How are we feeling? Justin, you want to kick us off?
I was going to say age before beauty, but no, it's when there's disruption like this, it creates opportunity, and it shakes things up. And I think most people have heard of Warren Buffett. He's famous for saying, "Be fearful when others are greedy, and be greedy when others are fearful." And what we've seen is it has really been a big opportunity, especially for those who do have cash to invest. And it never feels that way, but it does create that opportunity. And actually, the news narrative it's been really negative, and it's starting to shift. We've seen the market rebound. Today, this S&P 500 is positive again for the year. So the market has been better than I would say most people have as far as perception goes.
How about you, Buster? What do you think?
I think one of the original things that my mentor in the business told me in 1974, which was an unusually weird time to come into the business, was that the markets can take very good news and they can take very bad news. But what totally drives markets crazy, whether it's bonds, stocks, any kind of markets, is uncertainty. And that obviously for all of us in this world today is what dominates the news is uncertainty. And so when things happen and that are not definitive but could mean this or could mean that is when the markets get really, really jumpy and nervous. And it gets down to very simple stuff like supply and demand. And when people are fearful, they tend to want to get rid of things, to sell things. And when a lot of people sell with a fixed supply, it drives the prices down. And vice versa, when people get excited or positive about something, everybody wants to buy, it runs the prices up. So those are some of the basics that you just kind of have to keep your mind sort of fixed on as all of this is going on. I think it's time. I think the better word for me right now would be cautious, and that is to see where you are invested now, and to get yourself comfortable with that. And like Justin said, now is not the time to be selling. In fact, in a normal situation, when you go to the store, if there's a sale on something and it's much cheaper than it normally is, you go in there and you try to buy a lot of it, don't you? So when we talk about markets and investments, it tends to be a little bit different right now. So bottom line, now is not a time to be scared, just to be sort of aware of where you are, and is the but at some point in time, risk can be overwhelming. And if a person has invested in such a way of such certain degree of risk, and it becomes sort of all consuming, that fear, then there's a point where you might need to, for your personal safety, I guess, to get out of that. But as far as markets are concerned and economics are concerned, no, now's not a good time to do that. But the whole fear thing that Karen's talking about is all about the uncertainty in the world today.
And
There's
so
a
I'm gonna,
saying. I
oh, go ahead, Justin.
was just going to say there's a saying on Wall Street that's the market likes to climb a wall of worry.
Mm.
And so when you think about this pendulum of fear and greed, when everything is negative, like we're on the extreme side of the pendulum and it's going to swing to the other side eventually. And it's just a matter of how long that takes. And so, I mean, that's why you just got to have that contrarian mentality. And So yeah, it's invest based on your long-term goals, but when you have extra resources beyond the cash flows that you need on a short-term basis, like, hey, this disruption, it creates an opportunity.
Yeah. So much of what we talk about with, I know so many of our clients is talking about what is truly short-term reserves, what needs to be low risk, highly liquid, getting out of the bank, looking at it. And then we kind of set midterm and then we go long term. So many nonprofits aren't even touching those long term. Endowments are typically long term, but we get, whenever the market dips, there's just this influx of like, I just need you to tell me it's going to be okay. And I'm always like, we can't tell the future, right? And we talk about this. Our committee meets monthly, right? And we're looking at the markets and our portfolios and we make adjustments as needed. But really, it's a don't don't react with emotions as much as possible. I'm always like, take a deep breath. No one likes to check their account and see it down, right? But the reality is, if you are in long-term holdings, which is what you need to have if you're going to be more in securities, then you have to be able to ride the highs and the lows. And we're just going to diversify it as much as possible so that your highs are a little less high, but your lows are a little less low. And that's where we're starting to target those average annual returns. Uh, it is impossible to take emotions out of money, especially when you're a nonprofit leader, right? And this is donor money. And I know us as a committee, we take our fiduciary responsibility very seriously when we're like, hey, this is donor money, this is nonprofits. So generally, we're always in the more conservative side of things. But it is kind of nice when it's like, yes, it is an unstable environment and there's always new things, and the market's going to react to different things that are said. And I'm like, no matter what side of the aisle you are on politically, I think we can all agree that chaos is here to stay for a bit. Like, and depending on what he says, the market is going to react to that. So when everyone's like, well, what about in 6 months? And I'm like, I can't tell the future, but here's where the strategy, and when you choose a strategy, you need to stay with it. Rusty, what do you think?
So, I'm not going to, I agree 100% with both have said. I just want to focus on the fixed income side of the market versus the equity side of the market because, in historically, whatever has been good for stocks is theoretically, the capital comes from fixed income. But when people get scared and you have disruptions like 2020 or like what happened in April, there's a flight of capital, and that capital usually lands itself into fixed income, which puts negative pressure on interest rates, which means yields go down. And so when people are investing both, that fixed income portion of the portfolio that they're trying to, maximize the current income, the volatility in the stock market, the higher it is, the more fearful it is. There's historical precedent that it puts downward pressure on the current interest rates and the income that would get generated from cash or CDs or those type of things, because those yields would go down as people became scared and moved their assets into more safe type of investments to avoid that volatility that makes everybody so uncomfortable.
Yeah. And I know I'm giving so many of our clients, we encourage folks to go into fixed income, right? We're like, hey, let's make sure we have low risk, high liquidity over here, and then we can build into taking on risk. With that is a lot of the bond conversation. So I get a lot, and I know you guys too, where everyone's like, wait, I'm hearing in the news, again, that fear index, like what's happening with bonds? Or we have a lot of folks in like a rolling 91-day T-bill, and they're like, are these still safe? What would you guys say to that?
Well, it's backed by all of us collectively. It's
Yeah.
still probably the safest like cash alternative, I mean, in the world, in my opinion. I think we've seen this is probably not an appropriate audience for this, but like, cryptocurrency, gold have been flights. Like when we see the um, normally, like in this environment, we would see gold go up. And what's been really interesting this time is that Bitcoin has gone up when the stock market sold off. That's not happened before. Normally, that those two stay separate. But again, I don't think that's necessarily for this conversation, but it's something interesting to keep an eye on.
Yeah. And I know a lot of our clients do receive crypto donations. So we don't
Yeah.
allow you to
Yep.
buy it. We don't allow you to hold it, right? But we do allow you to receive it and then we liquidate it into cash. It is an interesting. Buster, what would you say about treasury bills?
Treasury bills, when you're talking about relative safety, if you're talking about the risk of not getting your money back at maturity, or in a longer bond, not getting interest when you're supposed to get it, then it's like Justin said, the treasuries are the strongest of those in the world right now. And within fixed income, we all have to remember that same adage of the more return possible, the more risk you're going to have to assume. And treasury bills, by their very nature, are very short term. So the yields aren't as great, but they are extraordinarily liquid relative to maturity. You can buy a government bond with a maturity of 30 years. Now, in a normal interest rate cycle, those yields are much higher than they would be on short-term stuff. You're in essence, you're paid to have your money invested for a longer period of time. And so those bonds in a given interest rate move will move back and forth as well. But if we're talking about the risk of getting your interest on time or the maturity when it happens, then the treasuries or the government bonds are the strongest.
Mhm.
So our clients have been asking around about, can we do better than money market funds? Can we do better than T-bill rates? Well, yes, you can. By going longer term and in some cases diversifying into the type of fixed income vehicles. And that's where diversification comes in. You don't want to have all of your money, all of it, in a short-term treasury bill. And at the same time, you don't want all your money in a 30-year bond either. So we have put together collectively models which are diversified such that within any interest rate environment, you may not get the very best, but you're sure is not going to get the very worst. And we're keeping the risk level down as well. So I think the answer is with diversification and staying with high quality uh, bonds, then that's the answer. Now, as Rusty talked about, there's some really unusual stuff going on right now in that we've seen some fluctuations back and forth on both at the same time, and enter into that picture of the Federal Reserve and what interest rates are, which of course determines a lot about what rates we're being paid on money market funds, CDs, treasury bills, and all that kind of stuff. And so that's all in a little bit of a fix right now. But I think the word that Justin used a few minutes ago was pendulum. And I will promise you one thing, and that is that there are pendulums in markets and in economies where things get so extreme one way that it comes back, always seeking that middle ground. And so we just happen to be in the midst of a pretty wide swing on the pendulum right now. But
Yeah.
treasury bills are the safest.
Yeah. Rusty, we got a lot of clients in fixed income. We encourage that quite often, particularly for reserves, and we have a lot of folks in just short-term rolling treasuries. What do you think?
There is no second place.
Mhm.
Like, the treasury is the safest asset in the world. And I think will continue to be that. I think the underlying risk with any type of fixed income investment is inflation. And which is, silent and, unpredictable. And so when a portfolio is structured to be too short term in nature, where you're just constantly rolling, it's very, very challenging to insulate yourself against the impacts of inflation. That's if there's any negative to a short term treasury investment, it's not from am I going to get my money back? That's not in my opinion, the risk. The risk is the money that I get back, how much is it worth relative to what that money is worth when I get it back? And yeah, so inflation is probably the real risk of a treasury investment. I worry not at all about, am I going to get is that bond going to mature? I lose no sleep at night at all over holding cash, holding treasuries, having FDIC insured money markets and all those type of things. I just worry about inflation.
Mhm. And it's something that we talk with clients a lot, where we're like, hey, well, what is the risk profile? We're used to banks. We have money sitting in a checking account or a savings account. A lot of nonprofits do CDs, which we can do, but as we all know, we avoid those just because the liquidity and all of the consequences that there can come from not holding it to maturity date. And usually nonprofits who have reserves, you may not touch it for 5 years. You may need it a month from now. You don't know. And the purpose of having an emergency reserve fund is that it's there for when or if you need it. So at Infinite Giving, right, it's like, right, you need it, click transfer, it's over there. So just so we can be really clear, we've got a lot of financial people on the call. We also have just a lot of nonprofit leaders who are in this responsibility role, but may not understand all of the market language. Collectively, we're all saying treasuries and fixed income are a great place to hold your funds in the current market. Agree? Disagree?
Agreed. Agreed.
Yeah.
I mean, comes down to what is that money for? What's the time horizon? And what's your risk tolerance? And so, yeah.
Right. And I always say, right, you have FDIC coverage on cash, which a lot of nonprofits work towards, but then who provides FDIC coverage? The US government. What has the full faith and backing of the US government? US Treasuries. So even though US Treasuries are not FDIC insured, they have a very similar risk profile because they both have the full faith and backing of the US government. So it's a really great spot to be. We did get a question that I'm going to throw you guys out just as we go, because it kind of is talking about the market performance. Jennifer Hurley said, as an Infinite Giving client, the S&P graph does not represent our holdings at Infinite Giving for the most part, which is true. So what does the volatility trend chart look like for Infinite Giving type of holdings, which generally we go more conservative? And we do hear this a lot, right? Where folks are like, well, the S&P 500 did this. And I know we all have lots of thoughts about this because we talk about it, where we're like, oh, it's top heavy and here's what that means. And also like your risk tolerance, we're always trying to balance it with bonds because we're trying to reduce your risk, which means your performance, right? Your highs are a little less high, your lows are a little bit less low. So as we're thinking about that, how would you respond to Jennifer when she's like, yeah, we understand the S&P 500, but like you can't benchmark most nonprofit funds and kind of portfolios against how you would look at the S&P 500. How do you think our performance compares?
Well, she's exactly right. And so many times mutual funds and other people use the Standard and Poor's 500 as some sort of a benchmark, and it's unrealistic in that that's not the way you're invested. And so in a perfect world, and we've talked about this before amongst us, in a perfect world, our benchmark would be the same basic asset allocations of what we have in each one of the portfolios.
If I may, just so it's like if you're in a 60-40, you're 40% bonds, 60% security.
Correct.
When you're comparing it to the S&P 500, you're 100% in securities.
Correct. The one thing I would say is we deal a lot with ETFs, and a lot of times those ETFs are a function of an index. So if we are for instance, there is an ETF called SPY. That's the symbol, and it is a Standard and Poor's 500 ETF. I will promise you one thing: it does exactly what the benchmark does if it's the S&P 500. We also look at benchmarks relative to bond indexes, and so again, what she's saying is exactly correct. But depending on which of the models of IG that you're using, then a different benchmark obviously needs to be considered.
Yeah, and Buster, to add to that, like international this year, I think is up 10%,
Yes.
because of the devaluation of the dollar. So the
That's correct.
currency risk that, was like, which, would you say would hurt the portfolio 2 or 3 years ago when the S&P was the best performing asset class, has been an absolute tailwind,
Mhm.
with all the uncertainty that's happened in this, quote unquote, repatriation of foreign assets to their own shores. The I think the international portion of the portfolio is up over 10%, and then value, which has been like one of those underperformers that you would be diversifying against the S&P because of all the reasons. Like, it's so top heavy, so few stocks represent so much of it. Like, value is positive this year.
Right.
Like, and it did not have anywhere near the declines that the S&P did when, Liberation Day took place. So, from an overall volatility standpoint, I think the accounts have been much less volatile than just a pure S&P 500 portfolio.
Yes.
Great. And we have another question too, that kind of I feel leans into this as we're talking about fixed income and treasuries. One of the questions is like, hey, our board wants no risk and will only allow us to consider CDs and T-bills for any funds. That's not uncommon, right? Usually that comes with a little bit of lack of knowledge or understanding about what is available. Sometimes people hear investment advisors for nonprofits, and either you're a larger organization who is like, yes, we understand that. We have short, mid, long-term holdings, and endowments are all invested in the market. Occasionally, I even get a client and they're like, are we allowed to invest? And also, just so everyone knows, the answer is yes. Nonprofits who have endowments are in the market. Typically, an endowment is in a 60/40 or 70/30 allocation. So they're considered growth accounts, which means, hey, we're going to target an average annual return of between 7 and 9% so that we can pull off that annual 4 to 5% disbursement, roll the rest back in, and that's how you have an endowment. It's a fund that's invested that continues to grow for decades to come. It's a key cornerstone of financial sustainability for a lot of organizations, but we won't even touch that until you have a healthy reserves. CDs are pretty old school. They're not bad. I know us as an investment committee, we generally don't encourage those. I think I mentioned that earlier just because of the lack of liquidity. And so if you're, doing an 18-month CD, right? A lot of banks are like, great. Well, if you pull out early, there's certain consequences to that quite often. And so there's often better alternatives, which is we usually talk about money market mutual funds, we talk about treasuries, and then of course, fixed income. What do you guys think about CDs for nonprofits?
They have their place, but I've been cracking up because I think about what Dave Ramsey says. He calls them certificates of depression. They have their place, and they need to be they're a good tool for that, for short term, for security. I personally like treasuries better because they're much more liquid, but they do have their place. But the biggest risk here, just like what Rusty said earlier, is they're not necessarily risk free. The risk that you have with treasuries or CDs is that your investment keeps pace with inflation. And so once you've got beyond what you have more that's conservative, that's invested in very secure assets that kind of provides that liquidity that you need, then we need to be looking at things that can outpace inflation.
Right. And that's a great call out is that we talk a lot about there's nothing that is zero risk, right? It is if you're putting cash under a mattress in your house, there is still risk. What if you were robbed? What if there was a house fire, right? And then there's the other side of like opportunity cost risk when you're looking at we're so afraid to do anything with the funds that we've been given because we are so overly cautious that they then just sit in a bank. We talk to people all the time, and it's like sitting in a checking account, cash account, savings account, making like 1%. Maybe it's wild and crazy and you're at 2% right now, right? And you're looking at that and you're like, I'm stewarding these funds well. I think a lot of the conversation is a gentle pushback of are you, when inflation, as you guys are talking about, is outpacing, right, what you're currently doing. Often, money in the bank, including CDs, is it's over 250K, is not FDIC insured. You're locked often into an interest rate that sometimes it benefits you, sometimes it doesn't. But if you need those funds, they are not available to you. So when you look at, again, we only serve nonprofits. So we talk all the time about what are our low risk offerings? What does this look like? What are our time horizons? And anything that we're doing should be able to be liquidated and in your linked bank account within, a couple of business days via ACH. So it's fee free. It's your money. When you need it, you log in, you click transfer. And to be clear, right, we do CDs, so we can offer CDs. We do a lot of seeders. Seeders are like, hey, if I have $1 million, we'll do 250K per bank. So it feels like one portfolio, but it's fully FDIC covered because we've shopped the best rates all over the US. But all of these things are why having an investment policy statement is really important. And that's something that we create for our clients all the time. It's part of our services where we can say, hey, let's work through kind of what these guidelines are. And as you think about reserves, right? It's if you guys are wondering, we get asked a lot about how much reserves are enough and how much is too much, right? Pre-COVID, you would hear 3 to 6 months of operational reserves was very standard. And then a lot of us felt it for the first time, where it was like, oh, this is why we have reserves. Like, what is happening? Like, how do, would the grant come through? Would that donor still, make that large gift that they usually make? And it was, even if we came out on the other side, a lot of nonprofit leaders did not. But if you did, and maybe even benefited you long term, it still kind of created all of us in, just like you would for your personal family. Like, you want to have a savings account. That's why you have reserves. So it's moved now from very standard pre-COVID of 3 to 6 months of operational reserves on hand to 6 to 12 months of operational reserves on hand. That is not a hard, fast rule. Every organization is a little different. There are a lot of right ways to do things. But I think a lot of that is like, okay, do we have that? Is it labeled? Is this our 6-month reserve fund? Where do we put it? How do we think about that? And when they come to us, that's where we're like, great, what can we do? Yes, there's treasuries. Yes, you can do CDs. There's money markets. There's mutual funds. But I think we often oversimplify it if we're like, we got to be in the bank, we got to do a CD. And as you get brokerage account and as you get a fiduciary partner like Infinite Giving, we're the ones coming alongside you saying, hey, let's talk about this. What is the duration? How are we thinking about these funds? Where should we put them? And then we look at all those different yield rates and all these different opportunities, and then we make suggestions. And that's why we just came out with this new diversified fixed income portfolio that I know several people are already going into, where it's like, how do we start to, particularly in this market where it's volatile. Some people are like, it's down market, we're ready to get in the market. Others are not. But we can help you navigate those pieces and kind of start to look at, we may not be in the market, but we want to do longer term. We now want to go over 5%. What can we do? And then, we help guide that and where we're landing. Rusty, sitting on a nonprofit board, or if you were a nonprofit leader, and you guys had 6 to 9 months of reserve funds. I know you know all of our portfolios, so you're a little bit biased, but where would you go? Where would you be like, this is where I would, of course, put all of our funds?
I mean, reserve is how, money that can be invested, but I also can get it back right away.
Right.
Right. Which CD never checks that box.
Right.
Right. I mean, and so I've never really understood CDs as a reserve asset, at all, and like, even if you did a 6-month treasury, like, or, where you tried to push like the maximum point of the yield curve right now, the treasury market is very, very liquid. So if for some reason you needed that money 3 days after you bought a 6-month treasury, you can liquidate it and the cash is in the bank next day.
Mm-hmm.
So like, when I think of reserves, I think of, what do I need in my checking account, like, in order to pay bills? And then what do I need for the next, 30, 60, 90, 120 days that based on inflows and outflows that I'm expecting, then maybe that is something that's 90-day T-bills, which once again, even if I buy a 91-day T-bill, I can sell it 3 days later. Like it doesn't have to be held to maturity. And then for the money that's just backup to the backup, like that can start to kind of find its spot on the yield curve in the short term to where you're maximizing yield. And I don't have the 1 year charts up right now on my computer. Maybe Justin, you do, but like where's the sweet spot in the yield curve over the next 12 months? And I think it's like 8 or 9 months, is it not? Or
Was.
I don't have my Bloomberg open. So, but that's kind of how I think of it as like, what do I need immediately, in order to pay bills? What do I need as just in case the donations don't come in like I expect over the next three? And then what do I need just in case, just in case? So I kind of have three different buckets there.
And there may be a fourth bucket.
Mhm.
And that fourth bucket may be for not-for-profit. So you have folks who give to your organization on a regular basis, which most probably will go to operational type, everyday type stuff. And that fits one of the buckets Rusty's talking about. And there can be another one for if you're in a facility and you have to, have some money available to fix the roof or whatever else. A third that we haven't talked about that is pretty specific to not-for-profits is if you have a capital campaign. Let's say that we've got a 2 year or 3 year capital campaign to do some big deal, whether it's a new building or some new project or something like that for our not-for-profit. That money, to springboard off what Rusty said, that money should definitely be set aside with a maturity expectation of when do you think the capital campaign is going to be over, 2 years or whatever else. And that money needs to be separate because all those people who have given to that capital campaign expect after 2 years that money is spent on that thing which they have raised money for. So you have a responsibility as a not-for-profit to keep that separate and invest it in a very separate way. Whereas you might have some money that you could afford to let grow over here, but that money needs to be set aside. So for you specifically as a not-for-profit, there's always going to be several buckets, and each bucket's going to call for its own risk, sort of a profile.
And we
You know,
manage
it-
a lot of capital campaigns, right? And multi-year grants. And as for a lot of our clients, we're opening multiple brokerage accounts. We're naming them, right? And then we're allocating those funds so it's really clean, it matches your balance sheet, and it's defined. This
Right.
is your 6-month operational reserve. We're going to put this in a money market. This is a capital campaign. Great. We're going to do some laddered T-bills, right? So we're always focused, particularly for grants and capital campaigns. And I know I'm always oversimplifying a little bit, but so when we look at it and it's like we're investing it technically, but also like, right, it's capital preservation. And there's so much of a responsibility to steward those funds well. And I think often we feel like there's this pressure to steward it well. We can't do risk and it has to sit in the bank. And I think what we often talk about as a committee and as we serve our clients is what you're defining as risk is also risky because you are choosing to not steward it well sometimes, right? And or you're taking additional FDIC risk. And then you can look over and say, well, I am fundraising for this and I'm going to spend it down. We do a lot. We do so many capital campaigns. They're like, hey, I have 3 years and then we're gonna, spend it down. And we're like, great. Let's run the numbers. If you kept it in your checking account or in a low yield savings account, here's where you would be in 3 years. But if you took that same money that you already have, stewarded it a little bit differently, and put it in a different type of account that is still low risk, highly liquid, and you have somebody who can guide you and plan you into that, then all of a sudden you can look at that and be like, wow, so in 3 years, I can have another $75,000 just by stewarding what I already have differently. There is nobody on this call that would not be incredibly happy, even if there was like a 20K check extra, right? So it's always looking at how do we make the money work for us well in a very wise and conservative way, right? So how we all invest personally is probably very different often than how we would invest nonprofit funds. And that's where the expertise of sitting in lots of board meetings and all of our investment committees is we're constantly looking at, here's what individuals might do. Here's what we think is best for nonprofits. And I know we got another question that was like, hey, well, what about just like a high yield savings account? Is that enough? What do you guys think about that?
Think of it kind of in the same line. It's liquid. It's available. You know, are we getting comparable rates? Yeah, maybe. You know, but that's not going to last. And as soon as the Fed cuts rates, boom, that savings rate yield is drops immediately. At least if you're in treasuries, you're going to see a little bump, even the short term. But it's a temporary little bump. But the longer term, the longer time until it matures, like the more bump you'll see when interest rates get cut. And that's, I think, something that, we've all got to consider is that rates are, pretty good now. They're not as good as they were a year ago, but they're still really good. And that we don't know if that's going to stick around, and we're going to need to look for opportunity elsewhere and know that as the current rate environment changes, like the time to make that change into something else isn't once interest rates come down or isn't once the high yield savings account comes down. We need to make that change ahead of time.
Yeah.
So,
and often I even like when we're looking at bank rates, I know so often we're like, great, what is your bank rate? And that high yield savings, sometimes there's competitive, but generally speaking, most banks are not offering nonprofits the most competitive rates. The banking system, it's a hill we die on sometimes, but I'm always like, it was not made for nonprofits. And you guys know that. Like, how do I, add someone to an account or take someone off an account? Or I just want to open a brokerage account. Why is that taking me 12 weeks? Right. And then they'll come to Infinite Giving and they're like, oh, you solved that. And you made that easy. And you can help us here. And all of this is clear and easy to use. And so if you're like, hey, do we have a high yield savings? Like our equivalent is an FDIC sweep program, the straight cash. Currently, it's at a 3% rate, and it provides FDIC coverage up to $5 million. Right. So, and we have lots of, ministries and charities and organizations who are in an FDIC sweep, happy as clams. Our job as a fiduciary is kind of like, okay, how do we get them from here to the money market? Right. And then the money market to maybe a little bit of fixed income. And everybody's different. And we work very closely with boards on that. But it is always like, how do we think about that? Where's that fear and emotion coming from? Is it perhaps a lack of understanding of what's available and how we can work with them? And then we're helping guide that. But I think often when you just look at a basic yield rate, most nonprofits are not getting, I've heard money markets at 0.08, even in this rate environment. I've heard 1.5, I've heard 2. Occasionally, if people say 3 or higher, I'm like, okay, that's actually pretty good. We're still better over here. Like our money market's like 4.25, right? So it's always looking at all of these. But yeah, rates, you can't always hang your hat on rates. So it's more about how are we being really strategic about stewarding what we have well.
the 30-day treasury is 4.3 right now. So yeah.
Not bad. And I think it is worth saying too that if you go through an advisor for T-bills, we can sell on the secondary market for you. If you are buying them direct, you cannot do that. And so there's a differentiation in liquidity. If you are kind of DIYing it, right? You have to go to the government auction. Again, it's a nonprofit account. It's different if you're doing it individually. You're buying from the auction, and then you have to, wait for it to go to maturity, and then you're repurchasing and you're looking at that. So you can DIY it if you want. Most folks are like, oh, I'll do it. And then they come back to us and they're like, never mind. And I'm like, right, that was it's, there are layers to that. But then the beauty too is that when we have liquidity needs, we're like, great. Someone's like, hey, I know my maturity date isn't for another 21 days, but we need $100,000, end of this week. We're like, great, no problem. We can sell it on the secondary market. We'll liquidate it and then transfer it over into your account. But they remain a really good option. Great conversation. Okay, I know we're at 15 minutes, so if you guys have additional questions, we've kind of thrown them in there as some of them have come up that has felt really valuable and applicable. What do you think that we are missing with nonprofits and when we're thinking about reserve funds and more growth accounts? And I think I'm asking that in a way of we often talk about what do you think that challenge is getting them to kind of understand and educate them in a way where it's like, hey, we can be in the market, but there are conservative ways to do that. What's the best way to get our boards? And maybe I know some board members are on here, or you have some nonprofit leaders who are like, we don't even understand what you're saying, but it sounds good, we think. What do you guys think the best way is for them to encourage their boards and organizations to look at something outside of just a bank?
It's as everybody on this call knows, including us, of course, because we're all involved in not-for-profits ourselves. It's a bit of a conundrum in that on every board there are much different levels of experience and tolerance to risk and understanding risk. And what you get with a larger board is a lot of times people who don't really understand anything about the markets and about investing simply because they have never been a part of that or that weren't raised around that or just flat don't understand it. It puts that person in a really difficult situation, and sometimes embarrassing to have to ask, basic questions. So I think the best thing that not-for-profit leaders can do is to educate the people in their board about the very basics of investing, and what the risks are, what the rewards potentially are, and to lean back, as Karen said, on an investment policy statement. You must have that. You must have that because as people come and are added to the board and leave the board, you've got to make sure that there is a culture of investing that is understood within the board of that not-for-profit. Now, it is not in stone. At any point in time down the road, the board can get together and change that if they feel like it's necessary, but it gives everybody pretty much a map about where to go. And I think what you need to do, those of you who are savvy about the markets and do understand, I think it's incumbent upon all of you to very patiently try your best to help folks who are not comfortable to understand, not to maybe sell them into doing anything, but just so that they'll understand the scope of it. And a lot of times when you use the word risk, people don't really think that through. I used to have some very wealthy clients who would say, I want to be really risky with this money. I've got plenty of money. If I lose it all, it's no big deal. Invest it and go for it. And I'll say, okay, let's say that it moves 10% in a month. Are you going to get upset about that? No, 10%, that sounds fine. Well, what I would normally do is say, okay, this is $100,000 account or $1 million account or whatever, take 10% of that and say, if I were to call you and say, your account's down $10,000 or $100,000, what would you do? I'd panic and sell everything. Well, we're still talking about 10%. And so a lot of times it's just a matter of putting into a language that you can understand what that risk is to determine. And remember that everybody on there is going to have his or her own risk tolerance relative to their personal money. And when you step onto a board like that, you are responsible for other people's money. And so whatever your bent is, it's going to be a lot more conservative than what you're probably willing to do yourself.
And that's where I think our fiduciary role is really important, because now you have, right, you have boards, you have really smart, good people who are pouring into their favorite organization, but you ask 10 advisors and you'll get 10 different opinions.
That's exactly
Right.
right.
Even the four of us were pretty aligned, but like there's a lot of lively conversation about what we think and how we can best serve our clients. And so when you're at a bank or where you're with a broker, they don't have a fiduciary responsibility. And so finding somebody like Infinite Giving, where we are literally required to hold nonprofit interests above our own, it gives us, I think, a certain freedom, and our clients feel a certain level of safety and trust when, like, there are often times where we're like, actually, keep your funds over there, right? That does make sense. Or let's look at, we all the time we get clients who are like, hey, I want to target the S&P 500 and it performed X amount, over this year. And I'm like, great, but let's talk about investor. I use that a lot too, where it's like, hey, so you say you want 15% average annual returns, but if you log in one day and it's down 20%, how does that make you feel? Which is a total trick question because it always feels horrible, right? But it's that element of they're like, well, that's unacceptable. I'm like, great. Let's change the conversation and look at fixed income, or let's look at what's a lower risk strategy. And maybe we have one client I know who took all of the yields. They did a nice conservative like T-bills and a money market mutual fund. And then they took that yield over several years, said that is what we're comfortable investing long term, because those are things we stewarded well. We have capital preservation, but now we're starting to think in 10-year cycles, 5-10-year cycles, and we now want to take these yields and put it a little bit more in the market and do a quasi endowment. So there's a lot of different ways, I think, but ensuring that you have a fiduciary, even when you have a board, and boards are fiduciaries, they're volunteers. Ideally, there's terms, right? You have rolling terms. And so we work really closely with boards and finance folks where we can come alongside and say, great, we're a third party. If that board member is DIYing it, right, there's all sorts of disclosures. There's what do you do if they underperform, right? Or what do you do if you're not happy with what they're doing? And then having an outside partner, I think, is really helpful in that way, where we can come in and say, great, here's how we're looking at the market. Here's what we're thinking. I think we have one last question and then we will gear up, but it says, when an organization is in financial distress, how do they make the decision of whether to reduce services or run at full capacity and close their doors all at once? Oh, that's a big, assuming they will not be able to raise the funds to save the organization. So a lot of the investment conversations we're having are a little less applicable in that situation. But we definitely wanted to address it looking at the economic uncertainty. I'm happy to weigh in there, but do any of you have any thoughts on that?
I mean, I've worked with a lot of startups, so it's always about burn rate. Like when you go into a traumatic situation, and they've always gotten as lean as possible, because if you don't go lean, there wasn't a chance of survival. And it was hard. I mean, I still remember one entrepreneur having, basically, I think he had to terminate his wife's brother, right? That was a hard conversation. But they had to do it in order to run the organization as lean as possible to survive kind of the economic uncertainty that they were facing. So it's not an easy decision at all. But what you're doing is valuable, and emerging on the other side is the most important thing when they were making the decision to go lean.
Mm-hmm.
Is that kind of what you were?
Absolutely. And it's so hard. And so I think if anything, we want to make sure that you all feel appreciated if you're taking your time and when you're on the front lines of working at a nonprofit, the work that you are doing, the work that is at hand is incredibly important, and you're actively making our world and society a better place. So when we look at, especially as an investment committee, and we're looking at just being a tool in your toolkit, we're looking to partner with you and we're saying, how can we help you move your mission forward? Sometimes these are the difficult conversations too. And there have been times where we've had organizations who have shut down, and we have worked with them on saying, great, is there another organization who's doing a similar mission that we can transfer these funds to? How are we thinking about that? And so it's stewarding the funds we have well, whether that's growing them, whether that's slowly building a reserve fund, or that's dispersing them, that we can serve them in that way. But it's tough, and a lot of nonprofits are facing that. So just know that you're not alone, and you're still appreciated. And Rusty, you said that so well, that it is valuable. And so yeah, I think there's different paths you can walk in that scenario, but there's certainly a way to put the donor funds to work in a mission that moves you forward. So last question, what do we think is going to happen in 2025, guys?
Huh.
Everybody wants to know the future. We don't have a crystal ball, but if you can go, I know we just got a couple minutes here, but Buster, what do you think about 2025?
I'm pretty optimistic about it.
Okay.
Simply because I think prior to all of the political confusion that we've had, the economy was basically in really good shape. You only have to go to the Atlanta airport to try to catch a plane to go on vacation somewhere to see that money is being spent. It's huge. So I feel good about the economy. I feel, back to my pendulum story again, with politics most especially, when things get going way too far one direction, it may take some time, but if you look back through the history of all governments, it will come back more towards the other side, sometimes going a little bit past center and coming back. But so I feel good about it. And in that regard, as long as we're speaking to people who are in not-for-profits, I want to remind you that psychology is really good for the stock market right now in the last few days. And so there are a lot of people who have gotten back or close to back to where they were prior to all the confusion and nervousness. And now's a good time. And some of them may, for their own reasons, want to take some profits or whatever else. And so now's a good time to talk to your donors about the possibility of selling appreciated securities. And we've got a system here where we can do that extraordinarily cheaply and come over the donor gets the benefit of the tax deduction for making the donation to your not-for-profit. Then you can turn around, and since it's a not-for-profit, you will not be paying taxes on that gain, and we can sit there and diversify that money. Which brings on one more question, and I'll shut up and let the other guys talk. One of the things, if you're on a board of a not-for-profit that has figured out that it's really good to take appreciated securities in there, there gets to be the point of how long do I keep that security in our not-for-profit account? It's sometimes it's really easy to buy stock, but sometimes it's not so easy to sell it. And so here we are as a board, and someone has given us some very volatile stock. What do you do? This is just a personal thing that I have found and used with schools and whatever else that I've been on the board of. I pretty much across the board insist that the board sell the security the second it hits your account. You do not want to get in the business of trying to figure out and to time stock markets on a given security, even a mutual fund.
Yeah.
So by the time it hits your not-for-profit, you now have the responsibility, not the donor. And so I strongly recommend that you sell it no matter what. It's the second it hits there. And that will you look at it a week later and say, well, Buster said that we should have sold it, and we did, and look at it now, but for every one of those stories, there's the other side where it goes down. You do not want to take the responsibility of a day to day on individual securities.
Yeah, great point. And we definitely do that. Eminent giving, we liquidate immediately. And even if it is in the market, we'll reinvest it into a further diversified fund.
Right.
So I know we are at time. We hope it was helpful for everybody. Justin, Buster, and Rusty, thank you for joining us in our time today. And for all of our nonprofit leaders, we hope this was helpful for you. We are here to help, whether you're looking at just how do we get into a better money market or savings or treasuries? We can do that for you. We can do endowment creation, investment policy statements, all of that. But ultimately, we are here to help and support you in the important work that you have at hand. So we appreciate you, and thanks for spending some of the time with us today. And we hope you have a good week.